Enterprise Products Partners, ticker EPD, is an American midstream natural gas and crude oil pipeline company that has been rising continuously over the past 5 years, rising by more than 100% from their 5-year low in 2020. And so today I want to figure out whether EPD is set to grow into the future and whether investing into it now will bring good return. And to do this, we'll use our fully automatic stock valuation spreadsheet, where we will have a look at the fundamental 9-pillar analysis and calculate the intrinsic value of the company using our 4 valuation models. Now the first thing we have to do is plug in the ticker EPD and wait for all the metrics to show up. Now right away we can see that EPD is a dividend company with a very juicy dividend yield of 6.61% and a dividend payout of $2.10. Now, one thing that frightens me about EPD is their very high trailing free cash flow payout ratio of 90%. And this means that the company, after paying out dividends, only has about 10% of their free cash flow left over to buy back shares, pay off debt, and invest into innovation while raising their current dividend. But as they are a company in the energy sector, they don't really need to push a lot of their free cash flow into innovation. But even though they still have very little free cash flow to push into the things I just named. So now let's move to the 9 pillars, and we can see that the 9 pillars give us a rating 9 out of 9, and everything is currently in the green for EPD. So let's start with the 5-year PE ratio. We can see that the 5-year PE ratio is sitting at 10.77. We want it to be sitting anywhere below 22.5, so this is in the green. And what this PE ratio means is that an investor pays $10.77 for every dollar of EPD's earnings. Now, a very similar metric to this is the price to free cash flow over the past 5 years to be sitting below 21. And for EPD, this is currently sitting at 16.15, which means that again, an investor pays $16.15 for a dollar of the company's free cash flow. We can also see that they have been decreasing their shares outstanding, which I very much like, and that their 5-year profit margin is only sitting at 15.65%. We obviously want it to be sitting above 10, so this is still in the green, but let's have a closer look at the 5-year profit margin. So we can see that although over the past 5 years it has on average been sitting at 15.65%, it has been decreasing at a rate of 4.34% yearly, and currently is only sitting at 12.63%. And the reason why I want the profit margin to always be above 10% is so that I know that the company is effectively managing costs and generates enough profit for growth. Now, if we jump back to the 9 pillars, we can see that even though the profit margin has been decreasing, the net income of the company, the revenue, and the free cash flow have all been increasing. So we can actually have a closer look at that. We can see that the revenue has increased from 32 billion to 49 billion in 2023. The net income has increased from 4.5 billion to 5.5 billion, and the free cash flow has also increased from 2 billion to about 4.3 billion in 2023. So there's no doubt that the company's profits are increasing. Now, another pillar we want to have a look at with every dividend paying company is for them to have consecutive dividend growth. Now, EPD's consecutive dividend growth is currently sitting at 3.35 yearly, but if we have a closer look, that is actually lower than the average year-over-year dividend growth for an S&P 500 company, but EPD makes up for that with their very high dividend yield. And finally, for the 9th pillar, we want to have a look at the long-term liabilities or the 5-year free cash flow negative dividends to be sitting below 5. And what this pillar basically tells us is that EPD generates enough free cash flow to cover all their long-term liabilities while paying out their current dividend. So that is what I talked about at the beginning. The company needs enough free cash flow to pay off debt, and they only have 10% to do this, but they seem to have been doing it quite well. As we can see, the ratio is currently sitting at 1.51, which means that they can pay off all their long-term liabilities with their current free cash flow in about 7.5 years, which is very nice. Now, as we can see, their long-term liabilities have been growing at a rate of 4.10%, but if we jump back to pillar number 5, we can see that the free cash flow has been growing at a rate of about 34% yearly. So the free cash flow actually outpaces the increasing long-term liabilities. So it seems like EPD is managing their free cash flow pretty well, and all the 9 pillars are looking very nice for the company. So now let's calculate its intrinsic value, first using the Graham's formula revised. And so we will take the 5-year earnings per share sitting at 2.31, the base P sitting at 7, 5-year growth estimate, growth rate multiplier, the average yield on AAA corporation bonds, and the current yield on AAA corporation bonds, and get an intrinsic value of $33.02, which is 4% higher than the current trading price, showing us that EPD is probably very fairly valued compared to their earnings per share. But now let's move to the second valuation model, which is the discounted cash flow model. And here we take the free cash flow over the past 5 years and calculate the average growth rate, as we already know, to be sitting at 34.98% yearly. Now, as I want to be a bit more conservative, I will plug in a growth rate of 12% into the future and calculate the future free cash flow. After that, I will plug in a discount rate, which is basically the minimum return I want from EPD. I will plug that in at 8.5% and calculate the present value of that future free cash flow. I will then sum all of that up, add cash and cash equivalents, and subtract their total debt to get their equity value, which I will divide by the shares outstanding and get an intrinsic value per share of $43.09, which is about $12 higher than the current trading price. And so now let's compare EPD to its competitors, so Energy Transfer, ONEOK, and Williams companies. And I have already made a valuation video for Energy Transfer, so if you want to check that out, you can do so at the top right corner of the screen. Also, if you enjoy these valuation spreadsheets and if you find them helpful, you can always download them at the link in the description. Now, I will take the current stock prices of these three companies and divide by their earnings per share to get their PE ratios. And you can already see here that the PE ratios of two of the companies are quite higher than the PE ratio of EPD, telling us that it might be indeed undervalued compared to its competitors. But anyway, we will average out these three P ratios for an average P of 20.70, and we will multiply by the current earnings per share of EPD to get an intrinsic value of $55.26. And this shows us that EPD is indeed quite undervalued compared to its competitors. But finally, let's jump to the dividend discount model. And here we take the dividend payouts over the past 5 years and calculate the average growth rate to be sitting at 3.26%. Now, as I want to be a little more conservative, I will plug in a growth rate of 3%, and using that I will calculate an intrinsic value of $37.55, which is slightly higher than the current trading price. And now finally, let's move to the ultimate valuation, where we will average out the 4 valuation models we just did and get an ultimate intrinsic value of $42.23, which is 32% higher than the current trading price. And if I plug in a margin of safety of 20%, we still get an acceptable buy price at $33.79. So overall, EPD isn't looking bad at all. Their intrinsic value is 32.85% higher than their current trading price, and the 9-pillar analysis is also looking very nice. The only things I would be looking out for is the decreasing profit margin and the very high trailing free cash flow payout ratio. And with that, I hope that you enjoyed the video. Make sure to let me know down in the comments which company you'd like me to evaluate next. Leave a like and subscribe, as it really helps me out.